There is a very specific kind of silence that falls over the market right before a storm. Right now, we are looking at a historic 13-day winning streak on the Nasdaq. It is a psychological state of absolute euphoria, a relentless vertical climb that has not been seen since the Carter administration. But beneath this surface of endless green, there is a structural fragility that should make any serious investor pause. We are seeing a classic divergence where the price has completely outrun the value. Today, we are going to unpack the architecture of this rally, look at the hidden risks, and map out exactly how to navigate what comes next.
It really is a fascinating moment in financial history. The phrase I use to describe this exact environment is euphoric caution. When you have a 13-day streak, it moves from being a show of strength to a massive signal of exhaustion. The market is currently priced for absolute perfection, and the problem with perfection is that it leaves zero margin for error. We are looking at a situation that perfectly mirrors the market structure just before the massive pullback in 1979. In that era, a similar streak led to a 100% retracement of gains 40 days later. We are essentially on day one of that danger window right now.
That 1979 parallel is chilling when you really sit with it. It forces us to ask a difficult question about human nature and our collective memory. We get so caught up in the momentum of the present that we forget the brutal lessons of the past. Let's ground this in the current fundamentals. The bull case right now is leaning heavily on an expected 17 to 19% earnings growth for 2026. That sounds incredibly robust on paper. But how much of that growth is already baked into the prices we are seeing today?
Almost all of it. That is the trap of the perfect pricing scenario. The earnings engine is absolutely firing on all cylinders. There is no denying that. But the valuation is the cliff. The rally is heavily concentrated in a few mega cap technology leaders. When you look at the PEG ratio, which measures price and earnings relative to growth, you can see exactly where the valuation error is getting dangerously thin. For example, NVIDIA is sitting at a PG of 1.221 and Microsoft is at 1.76. Those are actually fair value for the growth they provide. But then you look at Apple. Apple is trading at a 3.64 PEG ratio with only a 19% net income growth. That is fundamentally at risk. When a PEG ratio goes above 2, the stock is overvalued relative to its growth.
It is like driving a high-performance vehicle at top speed on a wet road. The engine sounds great, but the tires have completely lost traction. If we strip out those massive tech leaders, the rest of the market is actually trading at much more reasonable levels. This brings up a broader societal point. We are banking heavily on the promise of artificial intelligence and massive productivity gains. But if those promises do not materialize in the upcoming second and third quarter earnings reports, what happens to this fragile structure?
It collapses. The multiples will compress violently back to historical norms. We are already seeing the warning signs in the technicals. The SPY is currently trading around 710, showing a vertical ascent that has pushed the relative strength index, or RSI, into the extreme danger zone at over 73. For the NASDAQ, the RSI is hitting an absurd 84.5. And here's the most concerning part. This vertical move is happening on relatively low volume. That tells us this rally is being driven by a lack of sellers rather than a surge of new, high-conviction buyers. It is a thin market, highly susceptible to a flash crash if a negative catalyst emerges.
And those negative catalysts are hiding in plain sight. The macroeconomic reality is far from accommodating right now. Consensus suggests the Federal Reserve will maintain current interest rates through the entirety of 2026. We are looking at sticky core inflation projected to remain around 2.6%. There is no liquidity injection coming to save the market if it falters. We are essentially staring down the barrel of a stagflation-light scenario, yet the market is trading as if we are in a golden age of easy money.
Exactly. The market is climbing a wall of worry, but that wall has gone completely vertical, and we cannot ignore the geopolitical narrative. The primary catalyst for this recent streak is the Middle East peace trade. Easing tensions have allowed investors to put their blinders on and focus solely on earnings. But that means any reversal in those peace negotiations acts as an immediate black swan event for this overextended rally. The institutional players know this. While retail investors are experiencing extreme fear of missing out, the smart money is quietly moving toward the exits.
That institutional behavior is often telegraphed in other asset classes before it hits equities. Let us look at Bitcoin. It has historically served as a highly sensitive gauge for global liquidity. Right now, it is showing some recovery, sitting around 77,000, but it is struggling to reclaim its long term trend. What is the divergence between the crypto market and the equity market telling us right now?
Bitcoin is our canary in the coal mine. While equities are euphoric and hitting all time highs, Bitcoin is showing a dead cat bounce pattern. It remains significantly below its 200-day moving average of roughly 86,900. This divergence is a massive warning sign. Historically, when Bitcoin fails to lead a risk on rally, the equity rally eventually falters. The smart money in crypto is still de risking. Massive inflows from institutions are providing a structural floor at 75,000, but if the SPY hits our resistance target and rolls over, Bitcoin will likely act as a liquidity sponge and retest the 65,000 to 68,000 support zone.
So we have extreme technical overextension, a macroeconomic anchor of high interest rates, and a historical precedent that points to a severe mean reversion. The mathematical probability of a successful new entry at these levels is arguably at its lowest point in 2 years. It is time to transition from observation to strict tactical execution. Let us synthesize this into a definitive blueprint for our listeners. I want to break down our call to action across the 7 specific pillars of our analysis, starting with the current news sentiment and the fundamental reality.
I can lay that out clearly. First, on news sentiment analysis, the market mood is categorized as extreme greed. Retail FOMO is peaking due to the peace trade and the historic streak, but this is a classic contrarian sell signal. Second, regarding fundamental analysis, the underlying engine is healthy with expected 19% earnings growth, but the valuations are completely detached from reality. We have a severe priced for perfection dilemma, especially in high peg names like Apple.
Which leads us directly into the tactical approach. How are we applying swing trade analysis to this environment, and what is the specific buy and sell recommendation regarding when to actually start investing?
For swing trade analysis, we are issuing a tactical sell and short recommendation on the broader indices as we approach the 720 target on the SPY. This is a high conviction setup designed to capture the inevitable 5 to 8% air pocket that follows these vertical blow off tops. As for the recommendation of when to start investing, the answer is absolutely not today. We are issuing a strict avoid for new capital deployment. You must wait for the exhaustion phase to break and for the market to naturally pull back to historical support levels.
Precision is everything here. What is the exact price point to start investing at? And conversely, when is the moment to leave the market?
You want to start investing and deploying new capital only when the SPY drops to the 50-day moving average, which is the value zone between 675 and 680. For tech-heavy exposure, look for the QQQ to hit the 610 to 615 range. As for when to leave the market, if you are holding profitable positions, the time to start leaving is right now during the seller's window. You should be trimming 25% of your profits on high beta growth names immediately.
And to completely lock in that strategy, what is the exact price point to leave the market at to mitigate risk for the core positions we decide to keep?
The ultimate exit price point to mitigate risk is 720 on the SPY. That is the hard ceiling. If we touch 720, especially on low volume, you execute your final tactical exits. For your remaining long-term core holdings, you must tighten your trailing stop losses to exactly 695. If the SPY breaks below 700, the melt-up is officially over, and you want those automated stops to pull you out before the 1979 style retracement takes your capital. Additionally, target a 15 to 20% cash position right now, and consider a small hedge in VIX calls as fire insurance for the next 30 days.
It is a profound realization that the most dangerous moments in the market often look like the most beautiful. A vertical chart is not a ladder, it is a cliff face. The history of 1979 teaches us that the market does not offer a polite warning before a total retracement, it simply takes back what it gave. Discipline is not about predicting the future perfectly, it is about protecting your capital when the math no longer makes sense. Let the momentum run its final course, but keep one foot out the door. Thank you for joining us on the US Stock Picker podcast channel.
The information provided here and on this channel is for general informational and for education purposes only. It does not constitute investment advice, financial advice, trading advice, or any other sort of advice. We make no recommendations regarding investment decisions based on this information. You are solely responsible for your investments. Please conduct your own research and consult qualified financial advisors before any investing.